Hey there folks, and welcome to today's video. I'm super excited to talk about a true investing legend, Warren Buffett. You've probably heard his name before, and there's a good reason for that. He's not just any investor, he's one of the best of all time. I mean, we're talking about someone whose investment strategies have not just lasted for a little while, but for decades and decades. Now, what's even better is that the advice that I'm about to share with you today isn't some fancy, hard-to-understand stuff. Nope, it's practical, down-to-earth wisdom that you can start using right away to improve your own financial game. So, get ready to learn from the best and discover how you can make your money work harder for you, just like Warren Buffett has done throughout his amazing career. The power of long-term investing. Long-term investing is like planting a seed and watching it grow into a mighty tree over time. It's the practice of holding on to investments for extended periods, often years or even decades. The beauty of this approach lies in the magic of compounding. As your investments grow, they generate returns, and those returns generate even more returns. It's like a snowball rolling down a hill, getting bigger and bigger. This is a superpower in the world of finance because it allows you to harness the full potential of your investments. Warren Buffett is a true champion of long-term investing. He doesn't get swayed by short-term market fluctuations or quick-fix strategies. Instead, he believes in finding solid companies and staying with them for the long haul. He once famously quipped that the ideal holding period for an investment is forever. This means that when he invests in a company, he's thinking about the long run, not just what might happen in the next few months. Now, let's take a look at some concrete examples of Warren Buffett's long-term investments. One shining example is his stake in Coca-Cola. Way back in 1988, Buffett began buying shares of this iconic company, and he's never let go since. Over the years, the value of those shares has shot up, making it one of his most lucrative investments. This shows us the incredible power of having patience and faith in a company's future. It's not about constantly buying and selling like a trader. It's about nurturing your investments, watching them grow, and reaping the rewards over time. And that, my friends, is the true essence and power of long-term investing. Fundamental analysis and research. Fundamental analysis is like peeking under the hood of a car before buying it. It helps you understand if a company's stock is a good investment. It's all about looking at the fundamental aspects of a company, like its financial health, competitive position, and the industry it operates in. This type of analysis is crucial because it goes beyond just looking at stock prices. It digs deep into what makes a company tick. So, how do you perform fundamental analysis? Well, there are several steps, and they're like building blocks for your investment decision. First, you want to check out the company's financial statements. These documents are like a company's report card, showing its revenues, expenses, profits, and debts. Warren Buffett spends a lot of time studying these financial statements because they give him a clear picture of how well the company is doing. Next, you need to assess the company's competitive advantage. This is the thing that makes a company special and able to stay ahead of its rivals. It's like a secret sauce that keeps customers coming back. Warren Buffett often talks about looking for companies with a moat, which means they have a strong and lasting competitive advantage. Lastly, you should analyze industry trends. Imagine you're surfing in the ocean. You want to catch the wave that's headed for a big shore, not the one that's fizzling out. Similarly, you want to invest in industries that are growing, not ones that are declining. For instance, when Warren Buffett invested in Apple, he looked at the fundamental aspects of the company. He saw that Apple had a strong brand, a loyal customer base, and a growing stream of profits from products like the iPhone. These factors, backed by his thorough fundamental analysis, made him confident in his investment decision. So, by following these fundamental analysis steps, you can make smarter investment choices just like Buffett. Circle of competence. Imagine your circle of competence as your superpower zone in the world of investing. It's like knowing your strengths and sticking to them. This concept means that you should invest in areas where you have knowledge, expertise, and a deep understanding. It's like being a chef who excels at making Italian cuisine but might struggle with sushi. Staying within your circle of competence is crucial because it reduces the risk of making costly mistakes due to ignorance or misunderstanding. Warren Buffett emphasizes the importance of staying within your circle of competence. He believes in investing in businesses and industries he understands inside out. This way, he can make informed decisions and avoid the pitfalls of investing in things he doesn't fully grasp. Now, how can you find and expand your own circle of competence? Well, first, it's about identifying industries and businesses you're genuinely familiar with. If you work in the tech industry, for instance, you might understand the ins and outs of tech companies better than most. Second, it's a continuous learning journey. Just like a seasoned chef tries new recipes and techniques, you should keep educating yourself about the areas you're interested in. This might involve reading books, attending seminars, or following the news. Warren Buffett's investment in Coca-Cola is a classic example of sticking to his circle of competence. He understood the beverage industry and recognized Coca-Cola's brand strength and global appeal. This familiarity gave him the confidence to invest heavily in the company and hold on to it for the long term, reaping significant rewards. So, remember, investing within your circle of competence is a smart move, just as Buffett has shown over the years. Margin of safety. Think of the margin of safety as a protective cushion when you're riding a bike. It's like having some extra room for error to keep you safe. In investing, the margin of safety is a similar concept. It's about buying a stock for less than what it's really worth. So, if things don't go exactly as planned, you're still in a good position. It's like getting a discount on a valuable item. You're ensuring you won't lose money even if the price drops a bit. Now, how do you calculate the margin of safety for a stock? It involves two main steps. First, you need to determine the intrinsic value of the stock. This is like figuring out the real underlying worth of the company, considering its assets, earnings, and future potential. Then, you compare this intrinsic value to the current market price of the stock. If the market price is significantly lower than the intrinsic value, you have a margin of safety. Warren Buffett is a master at using the margin of safety in his investments. One of his most famous examples is his investment in American Express during the early 1960s. At the time, American Express faced a crisis and its stock price dropped significantly. Buffett saw that the company's intrinsic value was still strong, even though its reputation had taken a hit. He purchased the stock at a bargain price, and over time, as the company recovered, he made a substantial profit. This showcases how the margin of safety can be a powerful tool in investing, helping you protect your investments and potentially earn big returns, just as Buffett did with American Express. Patience and emotional control. Patience in investing is like waiting for a cake to bake. It takes time, but the delicious outcome is worth it. In the world of finance, it means being willing to hold on to your investment even when the market gets bumpy. It's about having a long-term perspective and not letting short-term ups and downs shake your confidence. Patience is essential because it allows your investments to grow and recover from temporary setbacks, like a strong tree standing tall through storms. Now, how can you keep your emotions in check when the markets get turbulent? First, avoid making impulsive decisions. Think of it like resisting the urge to buy a new gadget just because it's on sale. Impulsive decisions in investing often lead to regret. Second, stick to a well-defined investment strategy. It's like having a map on a road trip. It keeps you on track even when you encounter detours. Following a strategy helps you make decisions based on logic and planning, not emotions. Warren Buffett's career is filled with examples of patience and emotional discipline. One striking instance is his investment in the Washington Post company. Despite facing some challenges in the newspaper industry, he held on to the company's stock for over 4 decades. This required incredible patience and an unwavering belief in the company's long-term potential. His ability to stay cool under pressure and trust his investment strategy is a testament to the importance of emotional control in the world of finance. The power of compounding. Compounding is like a magical snowball effect for your money. It's the concept of earning interest or returns on an initial investment and then earning more interest on those earnings. This process repeats and grows your wealth exponentially over time. It's like planting a money tree. that keeps producing more and more money as it grows. Compounding is a key driver of wealth creation because it rewards you not just for what you put in it, but for the time you leave it to grow. Warren Buffett's long-term investments are a fantastic example of compounding in action. He doesn't just buy and sell stocks quickly. He holds on to them for years, letting his money grow and multiply. This patient approach has allowed him to turn modest investments into billions of dollars over time. To illustrate how compounding works, let's say you invest $1,000 in a stock that grows at an average annual rate of 8%. After the first year, your investment would be worth $1,080. So, at the end of the second year, your investment is worth $1,166.40. The process continues, and the longer you let it go, the faster your money multiplies. It's like a financial snowball that gets bigger and bigger as it rolls down the hill. This demonstrates the incredible power of compounding and why Warren Buffett and many successful investors swear by it as a key strategy for building wealth over time. What do you think? Which of Warren Buffett's timeless advice resonates with you the most? Tell us your thoughts in the comments below. Thank you so much for watching. If you haven't already, click the like button, subscribe to the channel, and turn on notifications to stay up to date with our latest uploads.